start with a broad overview of what we saw in global and local markets. The All-share index up 1.59%, 1.6%. What's pushing that up? People say it's resources, it's the platinum producers, it's the gold miners, the commodities looking up.
Yeah, if you go behind that 1.5%, you'll see resources up, I think, 2.2%. The gold price moving ahead. Now, look, don't ask me what's pushing this gold price to these kind of levels, because, frankly, I'm not entirely sure. Other than we're talking about a kind of risk aversion going away. We're talking about people going away from the dollar and back into commodities. And gold is leading the play in this one. And look, I suppose we must be very grateful for it, because it's doing a lot for our gold reserves and the like. But at 1106, 1108, it's moving far faster and far further than I would have anticipated even a few weeks ago.
All right, the dollar coming under pressure, people moving away from dollar-denominated assets, but we're also told that people also moving away from riskier assets in emerging markets. And so we shouldn't get very excited about what we're seeing locally, because that kind of risk appetite to go into emerging market equities is beginning also to rescind to some extent.
To some extent, you're right. And you know, there's a limit for everything, including risk appetite. And I think a lot really depends on what happens now in terms of the recovery in the world's largest economy, the US. And again, you know, for many weeks and months now, we've had conflicting signals. 2 weeks ago, we had the US GDP figure, plus 3.2%, looked great. On Friday, we get the unemployment figures at a 26-year high, 10.2%. Suggesting that the recovery may not be sustainable. And I think the critical factor we have to look at now is employment. Without people being brought back into the economy, that recovery, nascent as it is, may not be allowed to go an awful lot further. So we have to see people being employed again. Okay,
it's been results season in Europe and America here too. Yesterday we saw figures coming out of Vodacom, losses because of impairments in the investments in Nigeria, some regulatory issues here. Adcore's won its dispute with the arbitrator, so that's pushed up their share price. The Lewis Group also announced results. SAPI, you know, not as bad as you'd expect in a recession, but not positive as well, especially because companies like SAPI exposed to the European market. What are you making of the results coming out?
Okay, look, I went to the Vodacom presentation yesterday, and look, it was a workmanlike presentation, but as you say, not great results. This is a company that's probably gone full circle now. It's become fairly mature, at least on the voice side. Generating a lot of cash. As you rightly say, they've got a lot of write-downs occurring in some of their operations. What I found interesting was this new RICA legislation that's come in, whereby subscribers have to give details of where they live and the like. And that's having a very deleterious effect on new subscriptions. We saw it with Foschini last week in their results. They said cell phone sales were down. So there's an indication of where regulation is actually dampening demand. Peter Ace, the CEO, is confident that it's a temporary thing, and once people are used to it, it'll turn around and move ahead. They've got a lot on the data front. They are the leading cellular telephone ISP in the country. But I think from now on, it's probably going to be seen more as being a cash cow rather than growth. SAPI, you know, the Rolf Butker, the CEO, very confident that the demand improvements that we've seen in the past few weeks and months will be sustained. I think the jury may be out on that. I think the company has been trimmed back to cope with such a situation. But we have to wait and see what happens with advertising revenues, you know, for publications, which ultimately are buying paper.
They also depend on Europe a lot, and they're talking consolidation there. Let's talk about what's going to drive the markets today. Annual results from the Coronation Fund Managers, Mediclinic, Transex. Are you expecting anything major to come out today that will influence the markets?
Not, excuse me, not particularly. I think the markets will continue to be driven by the big picture stuff. We see Asia this morning going nicely on the back of what happened in Wall Street last night. I think our markets will pretty much be in line with that. We'll see a fairly positive start.
Here's an interesting thing. Big drama at Eskom, and I know we're going to talk about that a little later on in the management of parastatals. Chairperson resigns, an acting chairperson in the form of Mpho Makwana. Ego battles between the CEO and the board. The board's said to be in disarray because Alan Morgan also apparently in June had resigned, and people are expecting a split down the middle in terms of the board. No clarity as to the government position, yet the Eskom bond continued to perform well yesterday. What does that tell us?
I think it's telling you that largely and I use the word advisedly largely, investors are pricing an awful lot of this in. They're seeing pretty much what's going on. Having said that, in the longer term, Eskom, in my opinion, isn't going to be able to fund its longer term requirements through continued price hikes. It's going to have to go to the market, and you just mentioned bonds here. It's going to have to issue more bonds and probably more to foreign investors. So this kind of unseemly bickering at board level has to be done away with at a rate of knots, and we've got to see some cohesion coming back into the situation.
Let's talk about strategies for economic recovery and the policy options that are available, things that have been discussed at a G20 level, at an IMF level. Appropriate policy exit strategies. What should governments in emerging markets and developed economies be considering in terms of managing their debt, their budgets, their interest rate regimes, the stimulus packages?
I think this has come to the fore, as you rightly say, after that meeting in St Andrews in Scotland at the weekend. A couple of little cracks appear to be appearing in the G20's, up until now, very cohesive approach. They've been very successful in keeping economies afloat in the worst financial situation we've had since the 1920s. But now, as you rightly say, they have to start reeling back. We've got countries like the UK with a 12% budget deficit,
yeah.
US about the same. How are they going to do it? And I mean, I watched the press conference on Saturday, and I think it was Richard Quest from CNN made a very good question to Alistair Darling. He said, look, you guys are trying now to retreat. And you're getting other people to say, how do we retreat? And yet you are going to be putting your VAT rates up from January. You're going to be putting your stamp duty rates up. Isn't this going to actually kill the economy in its tracks before we go any further?
Right.
And it's a very real concern. So I think it's a very difficult one, and we're not seeing the kind of cohesion that you might have seen. The transaction tax that's been mooted for banks. The UK is all for it. The Americans have come out totally against it, and so has Dominique Strauss-Kahn and the IMF.
Just very briefly and finally on this one, you keep on making reference to the UK, and I think that's important because it's one of our largest trading partners in South Africa and in Africa at large, but it's the one big economy that's struggling to scrape itself out of the bottom of the barrel. The US showed modest growth, 3.5%. Germany and the UK and France, somewhere in the region of 0.3%, 0.4% in the third quarter. Britain is just not making it. Why?
I think it's paying the price for many years of, and it's probably the worst example, or the best example, whichever way you want to put it, of a credit explosion, a credit bubble, people living way beyond their means, and now to rein that in and to bring it back to where it should be is going to be a very painful process. And I think that's what we're now seeing, the material effects of that.
Indebtedness at 183%, you're going to have to explain that to me off air. That's in the United Kingdom, at least.